I once scaled a client's Facebook ads on a 3x ROAS and nearly tanked their business. Why? Because ROAS is kind of a lie. It doesn't give you the full picture of what's going on inside your business. And so in this video, I'm going to explain to you exactly what ROAS is, let's define it, but then also give you some ideas for other metrics you can use to track the health of your meta ads and the health of your e-com business. Why every business has a different break-even ROAS, and what you should track instead: blended ROAS, new customer acquisition cost, and contribution margin. I'm Jessie Healy. I'm a 7-figure exited agency founder turned e-commerce growth consultant. I've spent over $50 million on meta ads, and I've helped over 100 e-commerce businesses scale to 100K months plus. And today I'm here to help you make sense of the numbers without the jargon. Let's dive in. So, what is ROAS? ROAS stands for return on ad spend. It's simply your revenue divided by how much you spend. Put simply, it's how much revenue you're making for every dollar of spend you put into your ad account. Seems kind of simple. It's a good way to understand what is the return I'm getting for my ads. However, ROAS doesn't tell you if you're profitable. Your break-even ROAS, with what number your business should be aiming for, depends on the cost of goods sold, your shipping and packaging costs, and your overheads. So for some brands, a break-even return on ad spend might be 1.5x. For others, it might be 3 or even 5x. So a great ROAS in one business could be a terrible ROAS in another. So as a starting point, you need to figure out what your break-even ROAS even is. The problems with ROAS don't stop there. Meta's attribution model in 2025 is actually more inflated than ever. It takes credits for sales it didn't really drive, to be honest. If someone saw your ad once, then bought after a Google ad or an email or because they heard about you from a friend, Meta will still count it. And we've seen over the years this is happening more and more, that Meta is taking credit for almost every sale that's being driven if there's been even the minorest touch point of an ad or people seeing an ad or clicking on it somewhere in the funnel. So this means you could be scaling your ads at a 5x ROAS when the campaign's actually barely breaking even. So again, ROAS doesn't show you if the customer is new or returning, if they would have bought anyway, or whether your margins can even support that level of spend. And it certainly doesn't tell you if Meta was the main driver of that sale or whether that sale would have happened anyway. The ROAS that Meta is reporting to you inside Ads Manager has value. It tells you, according to Meta, what ads are driving the most sales. It tells you the click-through rate on the ads. There's a lot of data that's really useful to you to be able to have access to. But it's not the metric that I recommend that you use to decide whether your campaigns are working and whether to scale. So in this next part of the video, I'm going to dig into 3 metrics that I think you should use to get a better read on the performance of your ads beyond just what Meta is telling you you are getting as the return from the spend on ads. So let's dive in. The first metric I'm going to recommend you use is what is often called blended ROAS. What blended ROAS is it's kind of an average of all of the revenue that you've driven from all channels, basically your entire site revenue that is reported by Shopify, the true money that came into your bank account, divided by all of the spend that you spent on digital advertising. So if you're only running ads on Meta, it would be your total revenue, say your revenue was 100K in the last week, divided by your spend. Let's say your spend was 10K in the last week. That would be a 10 times return on ad spend because you've 100K revenue on your site divided by the 10K spend. Now that would be a 10 times blended return on ad spend. Now if you had, for instance, spent 5K on Meta and 5K on Google, it would be the same. The blended ROAS would be the same. But if you'd spent 10K on Meta and 10K on Google, your blended ROAS would be 5 because you've got 20K spend and you've got 100K revenue. It's kind of averaging up all of the spend that you've spent across different platforms and all of your revenue. It's not looking at like where that revenue came from. It's just giving you an average metric, and it will tell you every week as each week goes by how much revenue you generated from the spend that you spent. If you spent nothing on Meta, then and you put it all onto Google, you can then see the impact of that on the overall blended performance. So blended ROAS is a great metric to track every week to see how your overall marketing is performing. You'd still look at your Meta ROAS, but you'd look at it alongside your blended ROAS, which is telling you overall the effectiveness of your advertising. The second metric that I think is essential to track the performance of your marketing is new customer cost of acquisition. Now, similar to blended ROAS, it's giving you kind of an average across everything you're spending and the revenue that you're making, but this time we're looking at new customers. So the way you calculate calculate this metric is, again, you take your spend across all platforms, whether it's Google, TikTok, Meta, you add up that number, and then you want to take your total number of new customers driven in the time period we're looking at. So you just want to go to Shopify, you want to look at your new customer number, which is pretty easy to find right there on the analytics. You're going to go to analytics, you're going to go to reports, you're going to go to new versus returning customers. You're going to set the time period that you want to look at, maybe April, here, apply, and then this tells you the number of new customers that you got during this month. So once you have that new customer number, you want to divide your total amount spent by the number of new customers you've got this week. So in our working example, let's say you spent 10K in the last week on Meta and Google and you drove 10 new customers, then your cost of acquiring a new customer would be $1,000. If you drove 100 new customers, then your cost of acquiring a new customer would be $100 per new customer. So that's your new customer acquisition cost, sometimes called CAC, sometimes called NCAC. Now, the reason why this is so important to track is this is how you grow a business, right? You grow a business by acquiring new customers and being really good at retaining them. So if we're only ever looking at our blended ROAS or our ROAS inside Ads Manager, we're not going to know whether we're actually driving new customers to the business or whether the ads are just preaching to the converted and bringing back old customers. So if we track how much it costs us to acquire a new customer and make sure that that's a profitable equation, knowing how much a new customer is worth to us, then we can start to put more money behind our ads when we're hitting the new customer cost of acquisition that we have identified as being profitable for our business. Okay, so blended ROAS tells you the overall health of your marketing activities and your performance marketing channels, and cost per new customer acquisition, or MCAC, tells you how much it's costing you to acquire a new customer. But the final metric that really is the be-all and end-all for measuring the effectiveness of your campaigns is contribution margin. Now, this sounds like a little bit of a kind of scary accounting term, and it can be a little bit off-putting, but really what contribution margin means is it's your profit before you pay for your overheads. So it's your total site revenue on your ecom store minus the cost of goods sold, which will include like any processing fees, any delivery fees, packaging, anything that's a variable cost that will go up or down depending on how many products you sell, and then minus your ad spend. So it is revenue minus ad spend minus cost of goods sold. So it's what's left in your pocket that you then use to pay your overheads and ultimately to pay yourself. And that's why it's called contribution margin. It's what's used to contribute towards your overall overheads. So anything that is subtracted from that number should be those variable costs that are associated with fulfilling the order, including the variable cost, which is your ad spend. So that number is going to give you ultimately a read of how well are your ads doing from a profitability perspective. If you've made 100K in revenue, you spent 10K on ads, you sold, and that cost you 20K to buy all the product and deliver it to the person, the actual cost of goods sold, then that's 30K of variable costs that you've got in that 100K, and so 70K would be your contribution margin that's left over for you, or ultimately to cover any overheads you have, salary, storage costs, electricity, office, whatever ongoing costs that are always coming out of your business every month. So contribution margin will tell you ultimately when you spend more money on ads if you've actually made more money in terms of profit. If you doubled your ad spend and that week you had the same contribution margin, then you know that that increase in ad spend has not led to more profit. It's led to more sales, but it hasn't led to more profit. So that is it in a nutshell. The 3 metrics that you should be tracking beyond looking at ROAS in your ad account: blended ROAS, new customer acquisition cost, and contribution margin. Now you know why ROAS is such a flawed metric to use to measure the effectiveness of your campaigns. And now you know about the metrics that you should be tracking. You're probably going to want to know, where do I get these numbers from and how do I keep track of them? I have created a handy spreadsheet that you can use to keep yourself updated with these numbers and track them on a weekly basis or even on a daily basis. If you look below this video in the description, I've put a link to this dashboard that I have created. It's a Google worksheet that you can download and fill it in. It will take you about 10 minutes a week to have the numbers you need to scale your ecom store. Okay, so to fill out the spreadsheet, what you want to do is you're going to go first of all to Shopify. In this column here, you can see where the data comes from. So you're going to get the total number of orders for the time period from Shopify. You want to get the new customers and the returning customers. This is found in the analytics and the reports, the new versus returning customer report. You want to go and get your total site revenue, your gross sales, and put that in there as well. You want to then calculate your new customer revenue as well here. And then you want to go to Meta and get how much you've spent on ads this week. Go to Google if you are spending money on Google, and then any other ad platforms where you're spending money, fill those in. The blue ones are formulas. You want to put in here your profit margin. So for instance, if your product is typically $100 and it costs you $25 to make it, then your profit margin is 75%. So we're talking just about the profit margin, the gross profit margin, so the cost of goods sold effectively there. So this works out the cost of goods sold based on the total revenue minus the profit margin. Then pop in here your weekly overhead. That's your fixed costs. Those are not product related costs. Those are not variable costs. So those are the costs that come out of your business bank account every week, no matter what happens. So that might be salaries, retainers, electricity costs, your software fees. So like the amount that you have to pay to Shopify every month just to host your site, your Klaviyo fees, that kind of thing. Those will become your overhead number. And then you want to go to Klaviyo and look at how many new subscribers you've got this week. Go to Google Analytics or Shopify and find out how many sessions you've got this week. Look at your store conversion rate from Shopify and note that down. And then this calculates your AOV. So once you put those numbers in, you can now analyze, especially these blue sections here. So this will give you your blended return on ad spend. Will give you your new customer CAC. It will also give you your blended new customer ROAS if that's interesting to you. And it will tell you how much your contribution margin is. So what is the money that's left over in your pocket after you've spent money on ads, on fulfilling the product and paying for the product, what's left in your pocket, and then ultimately what's left in your pocket in terms of net profit or burn rate. So if you've got high overheads, then you'll be burning money. That number will be negative, but if you're doing well and covering your costs, then that number will be positive, and that's how much you're kind of building up cash flow in your business. So that in a nutshell is the dashboard that I would be filling out every week. And then once you start scaling, I'd look to do this actually on a daily basis as well. It takes about 5-10 minutes to fill it out, and these numbers will give you a really good read on how well you're performing, your business is performing, much better than just looking at platform return on ad spend in the Meta platform. Okay, so now you understand what return on ad spend is, why it's not a great metric to use, what 3 metrics you should be using, and you have a dashboard telling you exactly how you can track it. However, if you would like my eyes on your numbers or some help filling out the spreadsheet, or you just want to get a point of view on like how is your e-com business performing and get some fast feedback and some actionable insight, then please book a call with me. The link will be below this video on how to book a call with me and start getting some expert help on your e-commerce business. If it's something I think I can help with, I may invite you to join my coaching program or have some consultancy with me, but the call is completely free of charge and it's open to anyone with an e-commerce business that's hoping to scale.